Hello there, mortgage coaches. My name is Bryan Mehring. I'm one of the national trainers here at Mortgage Coach. It's going to be my pleasure to work with you in today's workshop and how to utilize Mortgage Coach to specifically paint a bigger picture with your client by utilizing the reinvestment strategy that you have available within your Mortgage Coach Edge software. So before we get started, let's do a little bit of housekeeping here, and I just want to make sure that I'm coming through loud and clear, that you can in fact see my screen. In the sample GoToWebinar control panel that I'm waving the mouse around here, it's very similar to the GoToWebinar control panel that you are using to access this meeting. I have a real simple ask in the question area. Just type in the city, no, let's go with the company that you're with. Type in your company. In the question area, hit the send button, and then that way I'll know that everything's working perfect. Excellent. Wow, you guys are on top of it. Perfect. So we have a lot of our enterprise partners, it looks like GreenPath, Fairway, Caliber, People's Home Equity, Finance of America. Excellent. So again, with this particular workshop, what we're going to do is show you how you can utilize the reinvestment strategy to paint a bigger picture with your clients. And the goal being is that you're going to be providing your clients with additional information that they most likely didn't think about, and most likely they weren't provided this information from other originators. It gives you a way to separate yourself from your competition, and it also gives you the opportunity to transition the conversation from maybe just speaking strictly about rates and fees to a bigger picture as to how they could utilize a mortgage as a financial tool to help them accomplish a particular goal that they may have. So what I thought I would do is go ahead and bring up a couple different presentations, go over different strategies first, so that way you kind of get the idea of what the picture may look like. And then I can go ahead and go into the nuts and bolts of how you would actually utilize the reinvestment strategy feature within Mortgage Coach. So let me go ahead and bring up a presentation here. And the reinvestment strategy, you could use it with purchase transactions, refinance transactions, also with your annual mortgage reviews. So it's a strategy that you can implement in different phases of where you're working with a particular client. If you're helping with a refinance, you're helping them with a purchase, whatever the case may be, there's a way for you to utilize the reinvestment strategy. So let me go ahead and first bring up a presentation here and share with you what it looks like. I'm gonna walk you through this as if almost like you were a borrower being presented with the different options. Okay, so here's my first presentation, and in this particular scenario, if you take a look at it, it's a standard 30-year fixed-rate mortgage, and it's for a purchase transaction. Oftentimes you might be working with a borrower that they could potentially put a 20% down payment down on the property, but maybe what they're doing, and it doesn't even have to be a 20%, maybe it's a borrower that's struggling with coming up with a 10% down payment. And the way that they're going about being able to put the money down for a particular property is they might have to liquidate an investment account that they're getting a pretty good rate of return on. So you as the originator have the ability to paint the picture for them is that, putting a 20% down payment is good, but you don't necessarily have to if it's going to cost you, say, maybe some opportunity costs with the money that you have in an investment account, or even, I've worked with borrowers that have had to incur penalties by taking money, say, out of like a very restricted 401k plan to be able to make a purchase on a home. So this particular strategy, if you take a look at this, this option here, is you can see that they're going to go ahead and put down a down payment. Here's your purchase price of $400,000, but they're not going to put the 20% down. What they're going to do is they're going to take and put only a $20,000 down payment, so a 5% down payment, and they're going to keep the money that they have in that investment account accumulating and working for them rather than putting the 20% down payment. And what I'm going to do is I'll show you a pretty cool feature with Mortgage Coach here that I like, is that I can go into the wizard here and bring up the products, provided that I've got the products built. Here's the 20% down payment here. So this is what it would look like for the borrower to put a 20% down payment, and this would be what it would look like if they were only going to put, say, a 5% down payment. I'll just simply arrow over to the right, and you can see that I'm only bringing up the products that I want by placing a check mark in there as I'm having a discussion with the client. So I'll simply arrow over here to the right. So it's like I'm working with you. You folks are going to be my client, and then I'm going to paint the picture for them. This 20% down payment will pop up here in just a second. I arrow it over to the right. It should pop up. There it goes. Okay, so here's the traditional method that most borrowers think about. They think about putting, a full 20% down payment, $80,000 into a particular property. Where here you're showing, you don't necessarily have to do that. You can keep your money accumulating in an account, and while you're keeping it in the account, you're building net worth. And what you're going to do is you're going to paint the picture with your client as to what their net worth will look like over the life of the loan. So if you take a look down here, you can see that there's two different colors. The green represents the equity that they're going to get with their home, appreciating over that 30-year period. But the orange area here are those additional assets. And for the borrower to see, what type of accumulation is occurring, all they would have to do is click on the More Info, go to the Reinvestment tab here, and you can see what they're doing is they're taking that $60,000, maybe they're getting a rate of return of 5%, and over the life of the loan, the 30 years, well, they're going to have over $250,000 by utilizing this strategy. What would you rather do, Mr. and Mrs. Borrower? Would you rather liquidate and have, say, $970,000 worth of net worth, or would you rather keep that money growing and have over 1.25 in net worth by the time that you get the loan paid off? Now, granted, they're going to have a lower monthly payment, you can see up here, but payment's not a factor. The risk or being able to keep that money in a different type of asset and accumulating over time is more beneficial for them. There you go. There's your game plan. So when you're working with the borrower, you've done an interview with them, you've asked them about the down payment, are they going to have to liquidate funds? You can paint this picture for them. And again, a lot of people don't know that you don't have to put a 20% down payment. You don't have to liquidate that investment account. You don't have to pay those penalties if you don't want to. There's other products that are available for you that will allow you to keep that money appreciating. So that's one example. Let me go ahead and go back. And then what I'm doing is I'm walking this through as if you were my borrower. So I'm going to go ahead and take the 20% down payment off, and I'm going to introduce to you the second product here. So I'm going to remove the check mark here, put the check mark there. And in this particular reinvestment strategy, and again, this is for a purchase transaction, this product option will change here entirely from 20% down to a different product name. It'll pop up. There it is. This is demonstrating to the borrower, let me clear all the highlights out. This is demonstrating to the borrower that, okay, you're going to become accustomed to making this particular payment. This particular product does require to have mortgage insurance, and you're going to become accustomed to paying that mortgage insurance over the life of the loan. This is, you're just going to get used to writing that check or having that being deducted from your account with an automatic withdrawal to the mortgage company. What happens when that mortgage insurance falls off? How could that help you? Well, what you're doing is you're going to paint the picture for them as to taking that mortgage insurance when it falls off, and if you take a look over here, apply it towards principal reduction. So you could become debt-free on your home more quickly. So in this particular reinvestment strategy, we're showing them that on the specific month that the mortgage insurance will be removed by them naturally making their payments and getting to that 78% loan to value. When that month occurs, take the money that was being applied towards mortgage insurance and then take it and apply it towards principal reduction. How is that going to help you? Well, you're going to pay off the home over 4 years more quickly than if you were to go ahead and, take that money and do something else with it. So again, you point out on the more info button up here, look at the reinvestment strategy tab over here, and click on custom, and you can see on month number 109, which is when that mortgage insurance is set to come off, take the money that was being allocated towards mortgage insurance and invest it in principal reduction. So they're going to take the $285 on that 109th month, apply towards principal reduction. That helps them reduce the term of their loan from 30 years to under 26. So I've been going on, and I just wanted to show the two strategies. There's several more, and again, I'm going to go ahead and I'll show you how to use, do the nuts and bolts. But is this relevant to you folks? Do you encounter these scenarios in working with your borrowers? I'd like to get a little bit of feedback from you folks. In working with your clients, you folks are out there in the trenches. Is this fairly common for you? Do you get these questions from your borrowers? Do they share these ideas? Okay, get some feedback in there. Is there anything else that, now that we're kind of got this reinvestment strategy mindset going, is there anything else that you could kind of, the types of questions that you're getting from your borrowers? Simple questions as, what happens if I just make an extra $50 towards the payment on a monthly basis? Those simple types of questions. That's how you could utilize the reinvestment strategy as well. Okay, good. Get some good feedback. And again, any type of other scenarios that you may want to encounter, this is your workshop. Any other types of scenarios that you think the reinvestment strategy, or knowing how to utilize the reinvestment strategy with your borrowers could be beneficial for you, be more than happy to show that to you. Okay, so I'm going to go ahead, and you probably noticed that I had a couple other products there as I was going through this. So I'm going to go back to Select Report, and then I'll remove the MI, and then you could take a look over here at this particular option that I'm going to bring up with you. And I'll go ahead and I'll get rid of the 30-year and just show you strictly this particular option. So this product will disappear, and then the other product will be there. And I've labeled this one investment, or invest the mortgage insurance with a 3% rate of return. So again, rather than applying it towards principal reduction, and you could give them both options. I'll put that other one up there. This one is principal reduction, and then this one is putting it into an investment vehicle. So maybe they're comfortable with, having to pay the loan off over 30 years, and they would like to take the money that they're saving from the mortgage insurance when that comes off and put it into an investment vehicle. And this is a great way also to be able to tie in those of you that are working with your financial advisors. So if you have some financial advisor partners, this is a great way to bring them in the picture, because they would love referrals. Hopefully you're going to be getting referrals from them. It's a great way for you to return the favor. And work with this person when you're in the purchase phase of the relationship with them, and share with them that, your mortgage insurance is going to fall off, and it's going to fall off on month number, let's see here, I said it was month number 109. When it falls off on month 109, you know what you could do with that mortgage insurance? You could take that $285 and after consulting with the financial advisor, maybe you get a 3% rate of return on that. With that, by the time you pay off your mortgage, the 30 years, investing that money, your time, the amount of money that you're going to be able to accumulate is going to be almost $100,000. Because again, you're most likely going to become very accustomed to having that money come out of your account anyways. Let's find ways that you could utilize that additional money in a productive way. You're already used to the payment going out of your pocket every month. Let's figure out how we can take that money and have it grow. And then you're looking down here, you could show the different net worth scenarios of where they're at. So it's a great way, again, for you to provide the borrower with additional information and share with them, separate yourself from the competition and share with them a different idea rather than having the conversation just about rates and fees. Okay, let's take a look at another scenario. And let me pull up this one here. So say you're working with a borrower and this is their current loan right now. And you're doing an annual mortgage review for them. And you're scratching your head because they had the opportunity, they had good time, they took advantage of purchasing a home when rates were very, very low. And you're going to do your annual mortgage review with them. And you're looking at it and you're kind of scratching your head. And here's their current loan right now. Well, potentially, you could do another 30-year mortgage, but what's that going to do for them? It's going to extend their loan, and are rates really going to be that much less? No. And if you take a look, why not share with them a way that they could take money on a monthly basis and just round up their payment. So if you take a look, here's their normal monthly payment here. And if they were to just round up their payment by allocating another $91.19 to make their total monthly payment about $2,200, call it a payment roundup, it's going to help them reduce the term of their loan, because remember, this is somebody that we were looking at potentially doing a refinance for, and it just doesn't make sense. This is an annual mortgage review. They've got 27 years on their loan. Well, if they make that additional payment, it's going to help them take over 2.5, almost a little over 2 years off the life of the loan. So are they going to act on that? Is that enough to have them actually do something? It may or may not. But what you're doing with the annual mortgage review, and that's one of the topics that we're going to be covering, this is kind of a little taste of it, is that it allows you to keep yourself in front of the client. You're going to give them a particular strategy, valuable information, and it's up to them to act on it. Are they going to act on it? Maybe, maybe not. But again, it gives you the opportunity to get in front of them, share with them how it could potentially help them, and then ask for referrals. That's one of the biggest things about the annual mortgage review, because you don't want them to forget about you and that you're still hungry. You still need, you still need to eat. You still need to have, clients sent your way from them. Okay, in the next column, this kind of gets, I guess you could say, kind of, I'll use the word nerdish, for lack of a better word. It gets kind of nerdish. And let me go ahead and I'm going to open up the reinvestment strategy here and open it up. And if you take a look at this one, what this is doing is it's showing that you have the ability for those borrowers that want to apply a lump sum, like an annual bonus that they get. And what I did is I labeled this particular product the tax return. So if you have a client that you know very well, and they're always getting a tax return, which isn't the best of things if you talk to an accountant, by the way, but if they're always getting a nice tax return, $2,000 invested each April or whatever month that they file their returns and get that lump sum, you can actually show them that if they apply that, and this is how you would go about doing it. And I only did it for about, let's see here, 1, 2, 3, 4, a series of 4 years, how that lump sum investment could potentially help them reduce the term of the loan. So there's ways that you can utilize the reinvestment strategy. It could be in the form of a lump sum. It could be in the form of principal reduction. It could be in the form of putting money in investment. There's a lot of different ways that you could apply this particular tool to paint the picture with your client. So this is a lump sum example, and I even took it a step further. This gets really nerdy, is it's applying both the payment roundup and the lump sum investment. So that's 2 strategies in it. I don't know if you'd ever, you potentially meet a client that goes that depth, but you never know. It's just so you know how to create the scenario. That's what's going to be important. The nuts and bolts of how to do that. And then let me show one more scenario here. This is with working with borrowers with a refinance transaction. So here's our current loan right now. In most cases, when you work with a borrower and they're doing a refinance, they need to do the refinance because they really have to increase their cash flow, right? I mean, they're feeling it every month. They're struggling to make things ends meet. You're helping them refinance and saving money on a monthly basis. So those borrowers are most likely going to be, focusing on the cash flow aspect of it, how you're going to be able to help them save money. But what you may want to do as well is share with them that, you've got that savings. If cash flow is not the sole purpose of, wanting to do this, maybe you want to take that money that you're saving, that $398.36 on a monthly basis, go ahead and maintain the same payment that you're making on the loan that we're going to refinance you out of, and you'll be able to shorten the term of your loan. So by now, by me presenting these presentations to you, you should start to see the different areas that you're going to want to focus in on in the total cost analysis presentation when you're working with your borrowers. You're going to be showing here freedom points. You're going to be painting the picture down here as to, is it net worth? Is it interest in MI that they're going to be saving? So you're going to primarily be using, these areas here, and then the tab up there with the reinvestment strategy. So that's what you're going to be focusing in on. And Mark, I see you typing information in the question area. I'm not ignoring you. I'll make sure to address all those questions that you have in just a moment. And for that matter, anybody else that has questions, please go ahead and fire away. Okay, next column over here. 3% investment. Okay, 3% investment. This is very similar to, the other presentations in that, okay, if you look at it, take that money that you're going to be saving by doing this refinance. Here's your current situation. Go ahead and apply that $398.36 towards an investment. So you're going to take that $398 and put it into an investment account. And then you're going to come down over here, and I would actually have to change this to net worth to show how that asset's going to appreciate by the borrower clicking on this. I'm using multiple strategies in here, so that's why this is currently at the interest in MI and the time horizon is at 20 years. So you kind of have to, in doing the interview with your client, well, you don't kind of have to, you have to really listen to them and find out specifically, what's going to be their motivation. If it's cash flow, you can maybe paint the picture for them that yes, you're going to get cash flow, but you can also even take a portion of it. You know, you don't have to pocket the full almost $400. Even if you're able to take $100 and apply it towards bettering your financial situation, either through principal reduction or investment, you can paint that picture for them as well. And then lastly, this is just at a different rate of return. This is, you know, a 3% rate of return. This is a 5%. Let me go ahead and I'll switch it from interest in MI to net worth, so you can really kind of see how those numbers really add up when you're putting it into an investment account. It could be a real eye-opener for your clients. And again, painting a picture for them that they, you know, they just might not have thought about. You know, they're always focusing in on rate. What's your rate? You know, how much is this going to cost me? That's important information, Mr. and Mrs. Barrow, but, you know, have you thought about this as well? You know, I'm listening to you. You know, you want to increase your cash flow, but how are you doing with savings for your retirement? Do you have money in a retirement account? Do you have any big expenses coming up? Do you have to put a kid through college? Do you have to save for maybe a wedding? And like I said earlier, one of the most common ones is retirement. So I'm going to go into the analysis area here real quick. Just change that metric from total interest in MI to total net worth. I'll keep it at the 20-year mark. You know, let me go ahead and extend it out. I'll go to the 30. That'll be a huge number by the time I get that in there. So if you look at the presentation now, you pull up the appropriate one, this one here. This will change from interest in MI there, it went to net worth in 30 years. So these last two columns over here with those different product options, you can see how they can accumulate, you know, a huge amount of net worth by applying that money and putting it into an asset. And it looks like I did a combination here. Let me look in this one here. Clear that. Let me look at that 5%. Okay. I was just curious there. So a larger rate of return. Okay. All right. So now you're probably all curious. Okay, I've talked about it. I've shown all these different strategies. Where the heck do you access this reinvestment strategy? How do you build a presentation? How do you use the reinvestment strategy? So my question to you folks, what would you like to see first? Would you like to see the purchase one, a refinance one, an annual mortgage review? What would you like to see, you know, the nuts and bolts of how you would do it? And I'll do the data entry and walk you through. Let's go ahead. Let's do it. Majority rules here. Do you want to do it for a refinance scenario, purchase, or annual mortgage review? I'll give you folks an opportunity to do some more, get some more votes here. Majority rules here. We've got a democracy. You've got to vote though. Gotta go to the poll here and or to the question area and type in what would you like to see. How would you be easiest to implement this particular strategy? How would it be easiest for you to implement the strategy and be meaningful for you when you're talking to your clients, not hypothetical clients, but the ones that you're actually envisioning yourself building a mortgage coach presentation for? We're kind of all over the board. Okay, we're all over the board. But it looks like the majority of you voted for annual mortgage review. And I'll do this. I'll start off with that one. And I'm going to build them rather quickly. So I'd be willing to bet that I could probably cover all three here in about 15 minutes and build them rather quickly so that you can kind of see what's going on. So what I'll do is I'll start it off this way. I'm going to go ahead and do new client. And I'm going to show you this particular method. I'm going to create a folder. And I'm going to label it Reinvestment Strategies. Is that spelled right? Strategies. I'm the world's worst speller. This first one, what I'm going to do is I will do the annual mortgage review. And then I'm just going to add to it as we go along. So you too could utilize this method. The reason that I'm recommending this particular method is that if you take the time to go ahead and build these 3 different strategies, or however many you choose to, just save them in your database, your Mortgage Coach database, and then you can quickly copy them and share them and just edit them to the particular borrower scenario. That way you don't have to recreate the whole thing over and over again. You can just simply edit it. Just a quicker way for you to manage your Mortgage Coach database. So let's go ahead and begin forward. So this is an annual mortgage review. And what we're going to do is we're going to show them that, you know what, you've got a great loan. Unfortunately, we're probably not going to be able to do anything for you. So I've researched the value of the home. The value of the home is $400,000. Because it's an annual mortgage review, I, as the originator, have all the details. And I'll say that this is the first annual mortgage review. So say they purchased the home in, let's go December of 2016. So that's when they made their first payment. In this case, I'll make it very simple. I'll say that they bought the home for, let's say that the value of the home now, they've gotten a little bit of appreciation, maybe $15,000, not a heck of a lot, but $400,000 was their original purchase price about a year ago. So not a huge amount of equity that's built up in that time. I'm going to say that, you know what, they killed it. They got a great rate, let's say 3.875. Their term is 360 months. They've got a 30-year. So now I know where their principal balance is at this moment in time. I can see their PI payment there. I'll go ahead and I'll put in their taxes and insurance. I'll just put in some figures. Oh, you know what? Let's get my original loan amount. I'm going to say $20,000 was a down payment. I'm sorry, or 20%. So that would be $320,000. You guys are supposed to catch that error there before I go on. Okay, and let's put in, I'll just use percentages, it's going to be quicker. Okay, so we have their taxes and insurance, we have their full TI payment now. So I'm going to go into the product area, and then in this particular one, let's see what their payment is. Okay, so their payment is $2,109.97. So in this particular strategy, let's share with them, let's go with $2,200 payment. We'll call it $2,200 monthly payment. So they're going to round up their payment. So all I'm going to do is copy from the current loan. I'm not going to do anything special. I'm just going to copy from the current loan. This is their current loan right here. We're not going to be able to do anything for them. There's no benefit, so I'm not going to include any type of closing costs. It has their monthly costs. And this is where you're going to locate and go to the magic button, I guess you could call it, the reinvestment strategy button. It's in the analysis area here. And if you go to adjust reinvestment strategy here, you can see here's the borrower's current loan, here's their current monthly payment, and then all we're going to do is we're going to take and round up that payment. It's going to take them, what, another, let's see, $90.03, right? Yeah, $90.03 to get their payment up to $2,200. So I'm going to enter that in the reduction payment field here. Once I enter that figure in there, you'll see that it will take the term of their loan from 29 years down to 26.17. So this would be me reaching out to a borrower, giving them the good news. Hey, you've still got a great loan. If you have any questions, give me a call. Be happy to adjust those. Don't forget about me. I'm your mortgage professional. If you come across somebody that could use my help, please let me know. Send them my way. That easy. You can take a look at what the presentation looks like. Here's a preview. It's comparing their current loan against the $2,200 payment. You'd simply, share with them the strategy behind it, include a nice little video. Video is very, very key there. explaining to them the strategy. So the video, they don't forget about you, they know who you are, and it's that easy. It doesn't take a long time. You can see I did it pretty quickly. And my promise to you is I was going to try and get through all of these. So let's go now. I'm going to show you a way managing your database here. So I'm going to go to that reinvestment strategy folder, and I'm just going to add another presentation. The next common request was for the purchase. So I'm going to come down here, scroll down to the R's. Here's my reinvestment strategy. Oh, wow. Looks like I already did this once before. Wow, looks like I've done this quite a bit. Oh my gosh. I can't believe I've done that so often here. Okay, so here is the presentation that I just built today. So I'm going to add it to this folder. So I'm going to highlight this, and then I'm going to go ahead and click Add Analysis. And this is going to be the purchase transaction. So I'll go ahead and I'll move forward, choose purchase as my goal. I'll use that same purchase price, $400,000. Again, I'm going to go through this pretty quickly. So for those of you that are new to Mortgage Coach, my goal in today's presentation is not to teach you how to build a presentation from scratch. It's more of how to utilize the reinvestment strategy to help you paint a different picture with your clients. We have for many other training courses how to build a presentation from scratch. But you'll probably get the gist of it just by watching me here. So here's a $400,000 purchase price. We'll put the 20% down payment. I'll put an interest rate of 4%. Term is 360. I'm going to scroll over. I'm going to go ahead and use a fee template, one that I've got built in here. Fee templates are a great way to save you a lot of time in sharing your costs. I'll just keep it real simple, and I'll add, again, using percentages. Okay, so now I want to go ahead and demonstrate another product option, and that's going to be, and I'll leave it up to you folks how you want to do it. This is going to be a copy from the same product, and we can go into, I'll just put reinvest here, and you can tell me what you would like to do when we get to the reinvestment strategy. So here we go. We've got our closing costs in there, because I used the copy from. I got the monthly costs in there. Let's go into the analysis area and click on the magic button here, the adjust reinvestment strategy. And what would we like to do? Do we want to show them? Actually, I didn't have mortgage insurance on that. Let me do that, because that would be probably very good for you, is the reinvest mortgage insurance. So I'll just make a quick edit here. Let's change it to a 5% down payment. Because you could always show them, how they can invest that money either towards principal reduction or into some type of an investment. I want to make sure I cover that for you folks. Okay, and let's put our MI factor in there. I'm just going to just put a number in here just so you can see for demonstration purposes. Put 0.80. I've got to do that for the other one as well. My mistake, I should have thought of that a little bit quicker. Okay, now we'll go to the magic button. So in this case, we'll go ahead and we'll show them, and I'll show you how you would take money and do it towards principal reduction, or you would take that money and put it in an investment. So if you look across right here where it says MI cutoff month, that's your target month, because the mortgage insurance is going to come off automatically when the borrower hits that particular month. So all you have to do is come up here in the reduction payment box, and I'm going to double click in there. You can see double click to customize the payments. You can see a little pop-up occurs. So I'm going to double click in there, and then rather than on month 1, I'm going to edit that so that says month number 106. And then I'm going to go ahead and enter the factor the amount of money that they're paying towards that mortgage insurance, $253.33. And then go ahead and click OK. So what it's doing right now is it's recognizing from month number 106 going forward until the loan is paid off that the borrower will be taking that money that they've become accustomed to that's coming out of their bank account every month. They'll be applying it towards principal reduction in this strategy. So there you go. You can see it's going to take the term of their loan from 30 years down to 26 and a quarter. Now I can go ahead and maybe just to keep it a little bit easier to follow, I'll add a third product, and this one will be towards an investment account. So this one would be, I'll put PR for principal reduction. And then let me add another product. And this one will be going into an investment account, and I'll show you how to do that. So I'm just going to copy again that second product option, and I'll edit it. So this is reinvestment, and I'll put, let's put it in a 4% rate of return. Okay. So again, I'll go into the analysis area and click on the magic button here, and then come down. Rather than working up in this area, this is all in regards to helping somebody reduce the term of their loan. And I'll just make it, I'll change that, double click in there. So we're going to delete that, and then we're going to take that money, rather than going towards principal reduction, we're going to put it down here towards an investment. And this is where I was saying earlier, great way for you to bring in your financial advisor partners. So I'll double click in there, and again it's showing me month number 106, $253. I'll go ahead and I'll put 106. So beginning month 106, they're going to take the $253.33, and they're going to put it into, on a monthly basis, into an investment account. And if you take a look at the number right there, that's going to show them how much money would accumulate in 15 years at a 0 rate of return. And then you go ahead and you talk to your financial advisor. What does a 4% rate of return look like? And you'll see that money grow. It goes to $21,545. And then you can adjust the time horizon too. So when are they going to have the loan paid off? Let's take a look. Let's go back to the analysis here. I've got so many tabs open here, I confuse myself. Let me do a preview of it. Okay, let these numbers populate. So here's principal reduction. They're going to shorten the term of their loan. Here they're still going to have it for 30 years. But if you look down here in the bottom right-hand corner, it's showing interest in MI, and it's showing 15 years. So if you're going to paint this picture, if you're going to take the time to explain that picture to your client, you want to make sure that the metrics are set up so that it's going to, help you, point out your case. So come into the analysis area, change the time horizon to the length of the loan. You could put in a property appreciation rate as well. I'll put 3%. But the big thing is that you want to change it from interest in MI to total net worth. I'll move over, and we'll see how the presentation changes here in just a second. We'll look down here in the bottom right, analysis area here. You'll see that this will change from interest in MI. There it goes. It's now 30 years net worth, and you can paint the picture for them that, you're going to become accustomed to having this amount of money coming out of your pocket every month. When the mortgage insurance falls off on I believe it's month number 106, take that money and put it in an investment account. This is what it's going to do for you. You're going to have a lot more net worth by the time that you have the loan paid off. There you go. So those were two of the scenarios. That was my goal. I actually want to get through one more, but for those of you that need to go, These workshops are set up for about 45 minutes, and I know I'm right at the threshold. I'm happy to go ahead and stay here and go ahead and go through the refi if you'd like. In fact, I'll go ahead and do it. If you need to go, by all means, thank you so much for joining, and I hope this brought value to you. If you'd like to stay, I'm going to go ahead and build the refi real quick. So again, what I'm going to do is I'm going to go home, and I'm going to add another presentation to that folder that I created. And I've done this once before, it looks like. Okay, so here's the two that I just did. I'll go reinvestment strategies. I'm going to add an analysis. Click yes. And then I'm going to name this one refinance. And you can see that by putting the name in the friendly name area, I'm able to see, which particular presentation belongs to which particular strategy. So this is going to be a refinance. So I'm going to go ahead and choose other for the time being. I'll say that the value of the home in the current market is $300,000, and maybe they bought it for $250,000, and they began making payments. Let's go about 5 years back. So let's go 2012. And if they originally purchased it for $250,000, let's just say they put that 20%, so their original loan balance was $200,000. I'll put their interest rate, let's go 4.875, 360, and I'll tab out, and you can see where their balance is at this point in time. There's their PI payment. I'll just put a percentage in here to make it quicker. And I'm going to go right to the product area. So this one we're going to label cash flow because we're going to see, all right, what is this going to do for the borrower? Let's give them a new 30-year mortgage. And I'm going to go ahead and first copy from the current and move it over to the yes refi. So here's our current loan. Let's say we could drop their rate down to 4%. There we go. And of course, there's going to be costs involved in this refinance. I'll use a refinance template. And you can see because I used a copy from it, I already brought in their monthly costs. And so this is going to help them with cash flow. So let's take a look in the analysis area here. So they're going to be saving $192 a month if they go ahead and move forward with this refinance transaction. So let's paint the picture for them, give them another option. Let's add a second product. And this is real easy. So what we're going to do is they're saving $192. Maybe you interviewed your client and they shared with you, you know what, we do need some help with their cash flow. But, we only need to, say, pocket $100. The $92 could be applied in a different way. So it could be either principal reduction, it could be in an investment, completely your choice. So this will be like cash flow with investment. How's that? Maybe they have to save for something and they would like to utilize that money, put it away, save for a particular event that's going to occur in the future at some point. So what I'm going to do is I'm going to simply copy from that previous product that I just built, cash flow. And the only thing that I'm going to do differently is go right to the analysis area, click on my adjust reinvestment strategy, and then because I said it's with investments, well, they're going to be saving, it was $192, I believe. Let's take and put $92 a month into an investment that's going to have a rate of return of, say, 4%. And we'll show them that over the life of the loan, let's see, 15 years. Let's go 20 years on our time horizon. 20 years, let's put a property appreciation. There we go. So when you look at the presentation now, we'll do a preview. You can see that particular strategy. Oh, let's make sure we have the borrower's current loan in there too. So select report, put that check mark in the borrower's current. There we go. Because there has to be a benefit in refinancing, right? So we'll go ahead and put that in. It'll pop up here in just a second. It'll show the current, the cash flow, and then I'll show the cash flow with the investment strategy if I arrow forward. There it goes. Okay, so here's a borrower's current loan. This is why they would want to do the refinance, because they're going to save $192. And then in this last column, they're going to pocket the $100, but they're going to utilize $92. And pop quiz for you, for those of you that are still in the workshop that didn't have to go, what would I want to change down here to paint the picture with my client in this analysis area here? What would be the things that I want to change? Let's see who's paying attention. Because right now it's showing interest in MI. If we're talking about building wealth, well, we want to have the position as net worth, basically. So let's come over here, analysis. We're going to change it from interest in MI to net worth. And then there you go. The picture will change. Change from interest in MI, and then there's that little orange piece. That's the portion of the money that they're going to get. They can find out specifically how much money that they're going to get over that time horizon, $33,743. So there you go, folks. Any questions here before we wrap it up? You can see it's a very powerful tool depending upon, you know, how good of an interview that you did with your clients. You know, what type of questions did you ask your borrowers to help you paint the picture for them? So it doesn't always have to be about rates and fees. You can paint a bigger picture that your competition isn't providing them with. All right, with that, I don't have any additional questions. We'll go ahead and we'll wrap it up for the day. Thanks so much for joining me. Now, this is the 10-day workshop, holiday workshop series. So as I mentioned, we have additional workshops that are coming up. We've already covered the open house, the move up, and we just covered maximizing the reinvestment right now. So look forward to seeing you in the additional workshops, utilizing these strategies to connect with your borrowers in different ways. Have a great afternoon, folks. Thanks so much. Bye-bye.